On June 17th, a man who quit the Federal Reserve in 2011 because he thought the money printing was about to wreck the country walks back into the building, sits down at the head of the table, and tells the world what he's going to do with interest rates. His name is Kevin Warsh. He's Donald Trump's brand new Fed chair, and this is his very first meeting running the show. Now, when he sits down at that table, there are really only three things he can do. He can cut rates, he can hold them where they are, or he can hike them. And depending on which one he picks, very different corners of the market are going to move. So instead of sitting there nervous, waiting to see which way the dice land, what if you understood all three outcomes ahead of time, knew where the opportunity sits inside each one, and walked in ready either way? That's the entire point of this video. Let's get into it. First, why this particular meeting matters so much, and why it's happening at the worst possible moment for an inflation hawk to take over. This morning, the May inflation report came out, and it was ugly. Headline inflation hit 4.2% year over year. That's the highest reading since April of 2023. It's up from 3.8% the month before. And it's the third month in a row that inflation has accelerated. It is not cooling. It is heating up. And the reason is sitting in your gas tank. Energy prices are up more than 23% over the year, and gasoline alone is up over 40%. The 2026 war with Iran shut the Strait of Hormuz, which the International Energy Agency called the largest supply disruption in the history of the global oil market. Oil hit around $94 a barrel and has stayed above $80 all year. Gas is sitting above $4 a gallon. So picture the box Warsh is standing in. Trump put him there specifically to cut rates. Trump has been loud about wanting cheaper money. But the actual data landing on Warsh's desk is screaming inflation. And this is not some random pick. Warsh was a Fed governor during the 2008 crisis, appointed back in 2006 as the youngest governor ever. Then he became one of the loudest voices inside the Fed, warning that all the money printing would eventually come back as inflation, and he resigned in 2011 over exactly that. He is, to his core, an inflation hawk. Now he's the one holding the steering wheel, and Trump is in the passenger seat asking him to floor it. That tension is the whole story. One more thing worth knowing before June 17th, because it tells you how to read the meeting even if the rate itself doesn't move. There are three signals the smart money is watching that day. The first is the dot plot, the chart where each official marks where they think rates are headed, and Warsh is openly skeptical of that whole exercise, so watch whether he downplays it. The second is whether he keeps holding a press conference after every single meeting, the way recent chairs have, or pulls back to fewer. And the third is the exact wording of the policy statement on inflation and jobs, because a single phrase getting added or deleted can move markets more than the rate decision itself. Keep those three in your back pocket. Let's walk the three paths. Path 1. He cuts rates. Right now, the federal funds rate sits at 3.50 to 3.75%, and it's been parked there since December of 2025. A cut means cheaper borrowing, and cheaper borrowing tends to light a fire under the riskier, faster-growing end of the market. Think about why. When money is cheap, big institutions can borrow more of it, and they go hunting for growth. So historically, a cutting cycle puts upward pressure on speculative and growth assets. The big tech names. Small cap companies, semiconductors, anything tied to artificial intelligence. Bitcoin tends to perk up because it loves loose money, and gold often catches a bid too, partly because lower rates help it and partly because people buy it when they're scared of inflation. Now I have to be honest with you here, because anyone who isn't is selling you something. This is not a prediction. I'm not a financial advisor, this is not financial advice, and you can absolutely lose money in markets. These are scenarios, not guarantees. Cheaper money creating upward pressure on growth stocks is a tendency, not a law of physics. Do your own research before you touch anything. But here's the catch with path 1, and it's a big one. The market does not expect Warsh to cut. The odds of any rate change at this meeting are sitting around 97% in favour of no change. The odds of any cut in all of 2026 are under 10%. Rate cut bets actually collapsed the very day Warsh's name was announced because traders looked at his record and went, "Oh, this is the inflation hawk." So if he somehow does cut into 4.2% inflation, that is a genuine surprise. And surprises are exactly what move markets the hardest. Which brings us to the most boring outcome that's also the most likely one. Path 2. He holds. He leaves rates exactly where they are. And honestly, this is what almost everyone on Wall Street is betting on, which means if it happens, the market barely flinches. No shock, no fireworks. The thing nobody priced in already happened. But boring is not the same as harmless. When rates stay high for a long stretch, you get what people call higher for longer, and it works like a slow squeeze. Mortgages stay expensive. Car loans stay expensive. Business loans stay expensive, and it quietly makes the national debt more painful, which I'll come back to in a minute because the number there is genuinely jaw-dropping. So where's the opportunity in a hold? It's patience, and it's perspective. Here's something almost nobody mentions on the scary news segments. Today's rates are actually close to the historical average over the last 50 years. We got so used to nearly free money in the 2010s that normal rates feel brutal. They're not high by history. They're just high compared to the cheap decade we got spoiled by. If you understand that, you stop panicking every time a hold gets announced and you keep doing the boring thing that actually builds wealth. And speaking of doing the boring thing consistently, if you're getting value out of this breakdown, do me one quick favor and hit that subscribe button. This is Sarah Finance, and we break down the money news that actually moves your wallet every single day. The Fed doesn't take days off, the markets don't take days off, so neither do we. Subscribe and you'll never get caught off guard by one of these meetings again. Alright, here's where it gets spicy. Peer 3, he hikes. Or even just hints that a hike is coming. This is the outcome that would genuinely jolt the market, and it's not as far-fetched as it sounds. JP Morgan thinks the Fed holds through 2026, but could actually hike by a quarter point in 2027 if inflation keeps running hot. Goldman Sachs thinks Warsh might use this very meeting to strip out the language about future rate cuts. And investors are putting the odds of at least one hike by the end of 2026 at around 60%. So a hike or hike talk is very much on the table. A hike is a shock, especially to the speculative stuff. Those high-growth, money-losing companies survive on outside capital, and a hike makes that capital more expensive. Fewer venture dollars flow in, startups feel the pain, the riskiest assets usually get hit the hardest. So where's the opportunity if rates go up? It flips to the opposite end of the market. Value companies, dividend payers, boring, profitable businesses that generate their own cash and don't need to keep borrowing to survive. When money gets expensive, the companies that already make real money and fund themselves start to look really attractive because they're not at the mercy of a lender raising their rate. It's the exact mirror image of the cut path. On a cut, the speculative growth names lead. On a hike, the steady earners lead. Same market, opposite winners, and now you know which is which before anyone says a word. One heads up though. Higher rates can actually pressure gold because higher rates defend the dollar and cool inflation, which takes away two of the reasons people buy gold in the first place. Same news, opposite effect, depending on the asset. That's why understanding the path matters more than guessing the path. Now, let me hit you with the curveball that makes this whole thing fascinating because Warsh has an idea that almost no Fed chair has ever tried. He wants to cut rates and shrink the balance sheet at the same time. The Fed is sitting on roughly $6.7 trillion in assets it bought over the years. Warsh's argument is that he can lower interest rates to make Trump happy while simultaneously pulling money out of the system by shrinking that balance sheet. And the second move cancels out the inflation from the first. Lower rates but less liquidity sloshing around. It's clever on paper. Does it work? Honestly, nobody knows, and some serious people think it can't. Critics argue that cutting rates and shrinking the balance sheet at the same time are basically working against each other, like flooring the gas and the brake together. So file that one under interesting experiment, results pending. And here's a detail that trips a lot of people up. This is not Warsh's solo decision. A rate move is a majority vote of the 12 voting members of the committee. He has to build consensus. He can't just walk in and bang a gavel. And the man he replaced, Jerome Powell, is still in the building. Powell's term as chair ended, which is the only reason Trump got to appoint Warsh in the first place. But Powell's term as a Fed governor runs all the way through January of 2028, so he keeps his vote. The criminal probe into Powell over that $2.5 billion headquarters renovation got dropped back in April with no evidence of any crime. He is not going anywhere. The new boss has to win over a room that still includes the old boss. Okay, the debt number I promised you, because it puts all of this in context. The national debt just ticked over $39 trillion, and the interest alone on that debt is running about $1 trillion this year. That's roughly $88 billion a month just in interest. Here's the part that should stop you cold. The interest on the debt is now bigger than the entire military budget, which is around $947 billion. We are spending more to rent our own past borrowing than we spend defending the entire country. That's why every single one of these rate decisions matters so much. When you owe that much, the cost of money is everything. Which brings us to the part of the story that should actually make you feel calm instead of scared, because we have been here before. Rewind to the 1970s. The dollar came off gold in 1971. Then the 1973 war in the Middle East triggered an oil embargo and prices exploded, exactly the oil shock setup we're staring at right now. The result was stagflation, a nasty combo of high inflation and a weak economy, and eventually the Fed did the painful thing. They jacked rates up into the double digits. Mortgages hit 15 to 18%. It crushed the economy in the short term, but it broke inflation, and people credit it with saving the dollar. Why does that history make me feel better, not worse? Because the people who stayed invested through that decade, who kept buying through the ugliest, scariest stretch, came out the other side just fine. The market didn't end. The dollar didn't die. The folks who panicked and sold at the bottom are the ones who got hurt. The system has survived an oil shock plus inflation before, and it's still here. So let's bring it all home. On June 17th, Warsh has 3 moves. If he cuts, growth, tech, crypto and gold tend to catch a tailwind. If he holds, which is the most likely, almost nothing shocks, but higher for longer keeps a slow squeeze on borrowing, and you remind yourself that today's rates are actually normal by history. If he hikes or hints at a hike, the speculative stuff gets rattled, while solid, profitable, dividend-paying companies tend to hold up better. Notice what that means. There's an opportunity hiding inside every single path, which is exactly why the people who build real wealth don't try to guess the one perfect move and bet the farm on it. They own a little bit of each side. They keep buying consistently, no matter what the Fed says. And they don't try to time a decision that 12 people in a room haven't even made yet. You don't have to be right about June 17th. You just have to be positioned for all 3, calm enough to keep going, and patient enough to let time do the heavy lifting. That, way more than any single rate decision, is how you actually win either way. If this helped you see the Fed as an opportunity instead of a threat, subscribe to Sarah Finance. We do this every single day, breaking down the money news that hits your wallet in plain English, so you're always the calmest, best prepared person in the room. I'll see you tomorrow.